The collapse of Silicon Valley Bank. 2 days after the collapse of Silicon Valley Bank, 3 of my colleagues in the technology industry joined me for lunch during the break. Meanwhile eating, one of them was reading some news. So she started the discussion about what had happened in the Silicon Valley Bank, the tech industry, and the condition of the economy of the country. As we sat at the table, we couldn't help but feel shocked at the news of the bank's sudden downfall and after effects. Sarah spoke up first, expressing her belief that the bank's risky investments and high levels of debt had caused it to fail. She argued that the bank had been too greedy and had not taken responsibility for its actions. John had a different perspective. He had heard from a source that the bank had been hacked and had lost a significant amount of money. He believed the security breach exposed the bank's vulnerabilities and led to its collapse. Alex, the most analytical of the 3, had a more nuanced perspective. He explained that Silicon Valley Bank had become a victim of its success. As the bank became more popular in the technology industry, it took on more clients and made riskier investments. Alex believed that the bank had grown too big too fast and had not adequately managed its risks. While we were all discussing and debating this topic, Sarah realized that our boss was listening to us all from a distance. The boss then came and sat with us. The boss explained to us that there were many factors that contributed to the collapse of Silicon Valley Bank. We all agreed that it was a cautionary tale for all financial institutions to manage their resources responsibly and be aware of their vulnerabilities. If you want to know about all the points which lead to the bank's downfall, then this video is for you. Intro. Hey there, tech enthusiasts. Welcome back to our YouTube channel, where we love to talk about all things related to business and technology. Today's topic is going to blow your mind. We're going to be discussing the collapse of Silicon Valley Bank. That's right. The iconic financial institution that has been the backbone of the tech industry for years is now facing a significant crisis. It's a shocking turn of events that has sent shockwaves through the business world, and we're going to break down everything you need to know. So grab some popcorn, sit back, and get ready to hear about the rise and fall of one of the most critical players in Silicon Valley history. The collapse of Silicon Valley Bank following a bank run has created a new problem for the technology industry. Mass layoffs in the hard-hit tech industry first made headlines in late 2022 and early 2023. This collapse is another setback for the tech industry and is the biggest bank failure since Washington Mutual in 2008. The U.S. government intervened to safeguard client deposits, and HSBC intends to buy Silicon Valley Bank's UK division. First, we should know, what is Silicon Valley Bank? Prior to its failure, SVB was the 16th largest U.S. bank and was established in 1983. They specialized in banking and financing for startup businesses with venture capital backing, primarily in the technology sector. Several tech executives, as well as venture capital companies, did business there. According to the Federal Deposit Insurance Corporation, SVB had assets totaling $209 billion at the end of 2022. Why was SVB important to the tech sector? About half of all venture-backed technology and healthcare businesses in the United States received funding from SVB. SVB was preferred for the technology sector because it supported startup businesses that other banks wouldn't accept due to higher risks. Consumers spent a lot of money on electronics and digital services during the pandemic in 2020, so this was a hot market for tech businesses. During this period of high cash flow for tech companies, SVB services were required to hold their funds for operational costs like payroll. Much of these deposits were invested by the bank, as banks frequently do. Why did it collapse? Numerous factors contributed to the failure, including a lack of diversification and a traditional bank run, in which a large number of customers withdrew their deposits at once out of concern for the bank's solvency. The majority of SVB investors were new businesses. Since tech was in such high demand during the pandemic, they deposited sizable sums of money from investors, according to Jay Young, creator and managing partner of Embark Advisors. Lack of diversification. Silicon Valley Bank made significant investments in long-term U.S. Treasuries and agency mortgage-backed securities using bank deposits. However, as interest rates rise, the worth of bonds and treasuries decreases. SVB bond portfolio began to decline in 2022 when the Federal Reserve raised interest rates to fight inflation. If SVB had kept those bonds until they were due to mature, it would have made its money back. Previously, Silicon Valley Bank made short-term loans. Instead of using short-term investments to cover their obligations in 2021, They switched to long-term securities like treasury bonds in order to increase yield. Because they were unable to sell their assets without suffering a significant loss, they were insolvent for months. Many bank customers withdrew money when economic variables affected the technology industry as venture capital began to decline. Due to the fact that these assets were bound up in long-term investments, SVB lacked the cash necessary to liquidate them. They began offering their bonds for sale at a substantial loss, upsetting buyers and investors. The bank failed 48 hours after revealing the sale of assets. Bank run. People were alarmed that the bank lacked capital when SVB declared a $1.75 billion capital increase on March 6. When word of the bank's lack of funds rapidly spread on social media platforms like Twitter and WhatsApp, the panic was sparked. Waves of customers began to take cash. After SVB announced a capital raise, its shares fell by 60% on March 7. Some claim that Twitter was the cause of the bank run. Clients of SVB had much bigger accounts than those in personal banking. The majority of clients had deposits that exceeded the $250,000 FDIC cap. Who was affected by the collapse? Because they were not protected by the FDIC on their investment. Unlike customers, SVB shareholders and investors suffered a severe loss. Lack of funds from deposits for immediate costs like payroll is one of the other problems. Etsy, Roblox, Rocket Labs, and Roku are a few large tech firms that have a sizable investment in SVB. Most institutions are covered by the FDIC. However, the funds were only $250,000, fully insured. This is not much when dealing with business accounts, because they may spend millions in a month. First Citizens Bank purchases Silicon Valley Bank. First Citizens Bank will acquire Silicon Valley Bank and take over the majority of its deposits and loans, the FDIC stated on March 26, 2023. On March 10, Silicon Valley Bank recorded $199 billion in deposits and overall assets of almost $167 billion. At a discounted price of $16.5 billion, First Citizens Bank will buy properties worth about $72 billion in its receivership. The FDIC will continue to be in charge of nearly $90 billion in assets and stocks. All 17 of Silicon Valley Bank's branches will operate under Silicon Valley Bank, a division of First Citizens Bank. How could this collapse affect small businesses and the financial sector in the future? The immediate fear may decrease with the U.S. government guaranteeing bank customers' deposits. After the assurance, stocks and financial futures rose by 1% to 2%. Customers of SVB were concerned about paying workers prior to the guarantee, which would have further harmed the economy. The more significant concerns are whether other institutions invest excessively in declining bond prices and rising interest rates. In order to help banks and credit unions satisfy customer demand, the Federal Reserve established a new program called the Bank Term Funding Program, which offers loans secured by mortgage-backed securities and U.S. Treasury securities. This scheme stops banks from losing money when they sell long-term government securities. The technology industry, which has been affected by the recession and has been forced to make staff reductions by larger tech firms, is currently the primary problem. Now one of their most prominent supporters has collapsed. According to Zhang, startup funding issues may arise because management teams at other banks are reluctant to accept the investment RISA. In a broader sense, SVB failure demonstrates the need for financial management in both prosperous and challenging periods. According to Jung, companies must take additional precautions in a recessionary climate due to factors like rising interest rates, supply chain issues, and challenges in raising capital. You can take some steps to avoid your loss in such situations. First, you can diversify your investments. Don't put all your eggs in one basket. Spread your investments across different types of assets and investment classes to reduce your overall risk. Secondly, invest in regulated financial institutions. Consider investing in financial institutions that are regulated by government agencies or have a strong reputation in the industry. Last but not least, you should not open multiple accounts with the max FDIC amount insured of $250,000. This is all for today. If you like this video, give it a thumbs up and subscribe to our channel for more exciting videos. Thank you.